Welcome everyone to our third quarter market commentary. Today is July 15th. We are recording after the close of the quarter, and like every quarter, we produce a commentary letter that goes out to everyone on our email list. It is also posted to our website under the Insights tab, and you'll find market commentaries there. And we also record this YouTube video and podcast to give some commentary in addition to the words that are on our article. Just like always, I need to remind our listeners that this information is meant to be a commentary regarding Consilio Wealth Advisors' view on the relative attractiveness of different areas of the market, contrasted with our current asset allocation strategy for the near term, which is considered to be 12 to 18 months. These views are always made in the context of a well-diversified portfolio and are not meant to be recommendations to buy into or sell out of a particular area of the market. These views can and will change as new information becomes available, and we will periodically update this brief to keep you informed of changes. In sum, if we talk about something on this production, about a specific stock, that is not a recommendation to buy that stock or sell that stock or buy that currency or sell that currency, etc. You get it. We've all been here before. It's not our first rodeo. Okay. Hal told me a funny story recently.
I was going to say, that reminded me of a hat that I saw.
So tell everybody about this hat you saw.
Yeah, this lady was wearing a hat that says, "This is my first rodeo." And I was laughing with her, not at her, because obviously you don't wear that hat without people obviously knowing the phrase.
It's a great hat.
Yeah. Genius marketing.
Genius marketing. All right. On today's episode, we're going to talk about the Magnificent Seven. We're going to talk about rate cuts, or lack thereof. We're going to talk about the strong dollar. We are going to cover the consumer, and we're going to give you our outlook. Hal, let's go ahead and kick it off here. So we'll start with the Magnificent Seven. What did the Mag 7 do last quarter? And just what's your take? What do you think it's going to do moving forward?
Yeah, the Mag 7 became still the Mag 7. It's we track all 7 stocks. That's Meta, Netflix, Tesla, Nvidia, Microsoft, Google, Amazon, and Apple, I believe. Is that 7? Yeah.
That sounds like 7. Yep.
And we track them. They're up 35% through June 20th. I drafted this before the quarter closed, just so we try to get out in a timely manner. But it still holds. It's outpacing the S&P during the same period, which is up 15.53%. And then the equal weight S&P is up 4.82%. So it shows you how much the difference between the S&P proper, which is cap weighted, right, which has more of the Magnificent Seven present in that index because it's capital weighted, and the equal weight, it just takes all the weight strips and equalizes all 500 stocks. So you hold the same amount of Nvidia as Chipotle, for example. So if you nullify some of the effects of the Magnificent Seven, you get 4.82% through June 20th. So not as great of returns, but it shows you how powerful the 7 stocks or 7 blue chips continue to be.
Sorry, I just had to close my window. There's a car alarm going off out there.
Not yours, right?
I hope not. Well, if it is mine, I can still hear the car, so nobody stole it. So
okay,
so that's good. We're good.
You just hear the alarm slowly fading away.
Slightly, yeah, exactly. Okay, so yeah, I think what's interesting there is that we saw for a minute that all these big tech companies were kind of flatlining for just a minute. And I remember we were talking a lot in client meetings. If you looked at, say, the NASDAQ and the S&P, and then the sort of the value category of the market, they were within just a couple of percent of a return for much of the year. And that was really, really healthy because in the prior year, 2023, the tech companies really blew it out of the water. But of course, the year before that, tech companies really tanked the market because they were down quite a bit more than a lot of other companies. And as you point out, have a larger weight. So it was, I think for us, good news to show that the markets were sort of behaving in lockstep at the earlier part of the year. And man, that's changed. That's changed dramatically here in the second quarter.
Yeah, it reversed, right? The broadening, or what we like to call a fuller participation, which ended 2024, it became the story of the Magnificent Seven. So any dip, whether it's professional managers, which I think is more likely the case, or retail traders, seeing a dip in Microsoft, for example, they would jump all over it because anyone who missed that run up wanted to participate. And I think that's explaining some of the FOMO trades that we've seen in the past, where you see this big run up, this dip, and then all of a sudden new buyers rush in. And it happens with a lot of asset classes, real estate namely, right? So anyone who's missed out on the real estate run wants to buy a house, but there's the conundrum of buying a house low or buying a house high, hoping it goes higher. That's the same pattern or cycle follows stocks, especially the hottest stocks.
So on that note about housing and whatnot, let's move to rates. So rate cuts, and actually let's even back up a little bit. I know that you and I on our podcast at the beginning of the year, we predicted how many rate cuts would happen. And what did you say?
We said, I say we because I think we're going to be wrong here.
You and I were in alignment, I remember.
Yeah. We said 0.
Yeah.
And we've been right so far. Since drafting this, the Fed has come out and softened its stance. So we said 0. The market predicted and started pricing in 6 rate cuts. So the far cry between 0 and 6, right? That's the difference of 1.5% and 0%, right? And right now rates are at 5.5. And if the market was right, we'd be looking at rates at 4.75. And then closing the year out at 4 flat. And that's right now the prediction. We're right. The market is wrong, at least for the time being. I hate when I say the market's wrong. The market prices in what the information it has, right? So right now it is looking like we are going to be more right than wrong. There's 3 more cuts that are anticipated, at least the end of this year. But things can happen. Inflation is, like as we've stated, is always noisy. It's going to bounce up and down, right? If there's another bird flu floating around, the price of eggs is going to go up. So these random events seem to impact supply chain or suppliers, where inflation does just pop up once in a while.
Yeah.
And I think that's normal. But we're in such a elevated state of inflation that little changes make big headlines for some reason. Well, we know the reason, but you know what I mean.
Totally. So for context, I think our view was that economic data wouldn't weaken as fast as the market thought it would. The market was pricing in 6 rate cuts at the beginning of the year. And that's by way of saying that the market thought that the economic data was going to deteriorate such that the Fed would say, we got to cut. And that hasn't happened. Spending has remained. People are flying. People are buying groceries. People are eating out. They're eating in. They're doing kind of everything. And consumer spending is 70% of U.S. GDP, which has essentially propped up the economy this entire time. So I think that's where the market kind of just missed their prediction. Yeah, I mean when they were predicting 6 rate cuts, I mean you and I were like, good luck. So
yeah.
And then strong job numbers, right? Like job numbers have been really good, and so that's also why the Fed hasn't cut yet, because the economy is actually pretty strong.
Yeah, and hopefully this is one prediction I was hoping we would be wrong on.
Yeah,
because
totally.
lower rates does loosen up a lot of things, namely the housing market.
Yeah. Let's spend a minute on housing. So you made a comment in here, and I want to ask you about it. So you made a comment that lowering of rates could actually be a negative impact on housing prices. And what you wrote about here was that right now, as rates have gone up, right now, the people that are locked in at, say, 3% on a mortgage,
Yep.
they're not moving. And so the issue has been that demand hasn't really come down, but supply has come down in the real estate market because there's so many people that are kind of locked into their homes, they're not selling. That's a problem. And so you said something that was interesting. You said, well, as interest rates come down, that could actually be downward pressure on housing prices because the people that are at 3% are now finally willing to sell, trade up house, and go to, say, 4%. I've always thought about it the opposite. So I just want you to expand on that a little bit. Yeah,
I think you're right in a normal market where housing affordability breaks down to monthly payments. So the higher the interest rate, therefore the lower the housing price should come in a normal functioning housing market, right? Mm-hmm. You have 100 buyers on one side, 100 sellers on another side. Like they're matched. And there's some shuffling going on, but the supply side and the demand side are generally in equilibrium. Mm-hmm. Right now we have demand that's way higher than supply because of the lock-in effect that you mentioned, mm-hmm. right? Because why would you trade? You want to upgrade your house and you're paying 2.75 on it mm-hmm. for 7.0. It's just not going to happen. And I've read and we've said that we think 5% is like the psychological threshold of mm-hmm. that trading up. But yeah, it does boil down to supply and demand. And if you're not putting your house on the market, that's one less house on the market. That's one less house in inventory. Mm-hmm. And we're seeing not a trend, but like a cliff where available housing went off the cliff. Yeah. So that's what I kind of caveat with the normal market is what Chris is saying is right. Higher rates should lead to lower home prices, but we're seeing it come out the other end where higher rates are leading to lower home inventory, which is mm-hmm. therefore creating higher prices and affordability crisis. So I'm arguing that it's not going to happen as soon as the Fed cuts rates from 5.5 to 4, if it ever gets there. The mortgage industry is linked, or the mortgage rates, the 30-year fix, is linked to the U.S. 10-year Treasury, mm-hmm. which is really dependent on free market forces. So let's say the Treasury, for argument's sake, is 5% flat. Any bank lending will tack on a 1 to 1.75 buffer, or what we call the spread, onto that 5%, making your mortgage rate 6.75 on the high end. Mm-hmm. And if that goes down, it most likely will be a result of the Fed easing rates a little bit. But there's other factors at play, right? If no one wants the 10-year U.S. 10-year Treasury, like everyone catches the gold bug and wants to go buy gold, that's going to spike the 10-year Treasury rate, and therefore mortgage rates will follow suit.
Makes sense. We'll see how it plays out.
Yeah.
Let's move over to the strong dollar. This has been an interesting one, and another prediction that you had made that maybe update folks on what your prediction was and what's happened. And then let's just talk about this, because you actually have some super interesting stuff. Everybody who's listening to this, make sure that you go in and check out our article that's on our website. We've got some great visuals in here, charts and stuff. So just little plug there. Make sure that you view this article too. But carry on with strong dollar, interest rates, and debt buying.
Yeah, prediction 3, it was the dollar will weaken finally. I think I've been making this call in a public forum for the past 5 years, and I've been wrong. This is wrong again. The dollar is up. The dollar index is up, and I'll give you the details of that. It's up 4%, and in terms of currency swings, 4% is a big move. So the dollar index does measure the U.S. dollar against the euro, the Japanese yen, the British pound, Canadian dollar, Swedish krona, and Swiss franc. And all those are weighted. And against the dollar. So if I were weighing the dollar against the Mexican peso or the Canadian dollar, I'm going to get a different performance, but we stick to the dollar index for consistency's sake.
Mm-hmm.
So when the dollar is historically strong, the natural next stage would be a bit of a regression back to the averages, which arguably hasn't happened in the last 5 years. The dollar has gotten strong, historically strong, and historically stronger, which is very, very abnormal. It does happen, but that's abnormal for a currency to stay and strengthen during its run up. The things happening with the dollar are more events outside of the U.S. I think stability is first and foremost the biggest thing that countries look for, right? Argentina is going through hyperinflation, and they just had a regime change, so they're looking for stability. They're looking to ditch the Argentino peso and go with the U.S. dollar out of all currencies in the world, right? And that creates more dollar demand. Political instability outside of the U.S. includes like Mexico, France, obviously the Middle East, and anyone else who is looking to improve their economic status, right? If their currency is going through devaluation like Japan is, right, you might want to park that Japanese yen into U.S. dollars for stability, right? Because you're losing value every day, at least in the last 6 months, if you had Japanese yen. So that's kind of like a real gloss over of why currency moves, right? Interest rates is the next thing. Out of all the central banks, the Fed has yet to cut, right? The Bank of Canada just cut in June, and so did the European Central Bank. They cut also in June. So you have all these central banks that are cutting, and you have people who want money market, and the U.S. is paying 5.25, right? Where are you parking your money if you're a sovereign wealth fund in Germany or a pension fund in Spain? At least the safe portion of it, you're going to U.S. Treasuries because the interest rate payment is higher. So that's all that demand is increasing the U.S. dollar demand. And this is despite U.S. debt levels, right? Or debt levels across the world. The U.S. does have more out of the developed nations, right? The U.S. is in there with England, Spain, France, where our debt to GDP is over 100%, right? The U.S. is at about 123% as of the writing. And so that's kind of a counterpoint to why the U.S. dollar has strengthened, right? That should give reason to sell the U.S. dollar, at least from our point of view. But where else can the money go, right?
Yeah, much of that happened in the last number of years. Financial crisis, COVID, pushed us well over 100%, not well over 100%, but call it 120 for rounding. We were nowhere near that not that long ago.
Yeah, and again, this is a pathway that had been trending well before COVID. COVID definitely spiked things up, but when you cut taxes and don't really cut other benefits, that's considered spending, right? So you're bringing in less revenue, but you don't reduce your costs. That's going to be an issue if you're a debt watcher.
So we have a great chart in here that shows the world and sort of a heat map on percentage of GDP of debt. So everybody, jump in and see that on the article. I want to shift us to the bid to cover ratio. I'd love if you could explain to our listeners what this is. And again, you have a really, really great chart in here, so everybody kind of jump in and see that too. This, to me, reading this was actually pretty interesting, related to how the U.S. debt has gone up as a percentage of GDP, but it doesn't appear that any of these coverage ratios are negatively impacted by that. So what is this ratio, and what are you seeing in this data?
Yeah, so every week the U.S. Treasury goes to auction, and they say hey, this is what the interest rate we're offering, and the bidders come in, right? And let's say we have to sell $100 billion in treasuries, and the demand that comes in, let's say it's did I use a billion or 100 billion?
You said 100 billion.
Okay, so the demand that comes in, let's say it's 200 billion, and I sold 100 billion while the demand was 200 billion. That bid to cover ratio is 2 to 1, meaning there's two buyers for every $1 that I am looking to sell in U.S. Treasuries. The scenario I presented is actually better in reality. The bid to cover ratio in June was 2.67, meaning for every dollar in Treasuries offered, there was 2.67 bids or dollars in demand that was willing to buy U.S. Treasury, despite higher debt. The term here is catching a bid. If you hear that, when we don't catch a bid, that's when you see the Treasury needing to up their interest rate payments or interest rate offerings to attract buyers. So 2.67 in like a historical context, going back to 1994, is actually more healthy than it had been in the last 30 years. So the 2.67 wasn't as high as 2010, 2011, because everyone was a rush to safety. So typically when you have a risk asset and things just go crazy, you're going to sell the risk asset and buy the safe haven asset,
Right.
which is U.S. Treasury.
Right.
So right now we have a very healthy 2.67, only lower than the post-housing crisis.
Yeah, like 2018. Really, 2018 through today, it's been almost exactly at this number.
Has not moved.
Has not moved.
Even during COVID, you saw a little bit of an uptick, but it was so quick that people who bought treasuries just simply sold those and bought back to the S&P.
And interestingly, it was lower. So from, call it 94 to 2002, it was maybe like, 2.2, 2.3, something like that. And then it dipped in 2004, but still to maybe 1.9 or 2. And then it came back up to the roughly 2.4, 2.5 level. Then it spiked after the financial crisis, as you just pointed out. The spike, it looks like it peaked
3.2, looks like,
about 3.2, and right about 2012 it started to come down, had a downward trend all the way through 2018, so like 6 years of downward trend, and then it's just been holding steady at that 2.5, 2.6 or so number.
Yeah, and in the news, Japan and China have definitely tapered off or completely shut off their demand for U.S. treasuries. So we're still catching those bids without those two big buyers or traditional buyers in the mix.
Wow. Let's keep moving here. Let's shift just quickly to the consumer, and then I want to leave everybody with our outlook.
Yeah, Chris mentioned that the 70% consumer spending, 70% of it is attributable to GDP. So that's a very large aspect of GDP. And as we're concerned about how big government is getting, the consumer is still more than twice as big, right, than the government spending in that respect. The U.S. consumer has this fearless charm that the other countries don't, and we spend like crazy, so much so that it might be our strength might be an eventual weakness, right? Because we are seeing rising debt levels, nothing beyond historical trends, but debt, credit, things like that the U.S. consumer loves. That kind of leverage does do well in up markets, but doesn't do so well in down markets.
So in sum, the consumer is on good footing. We actually talked about this on our latest podcast, which just went out. Actually, it'll go out this Wednesday. We recorded it last Friday. And we talked about there how household wealth is up, income is up. Consumer credit card debt is up, but not nearly at the highest levels of like 2007. Like,
Correct.
I mean, a fraction of that. So consumers actually on pretty strong footing. That's probably why they keep spending.
Yeah, and that's what's kept us up.
All right, let's move to our outlook.
Yeah, the market, what we think is the market should stop treating rates as the sole focus. It's definitely been the narrative in the last, 18 months. When rates
So true, by the way. I mean, every time some news comes out, whether it's jobs or it's the Fed or something, like the market just bounces around because it's trying to reprice whatever they're saying, and it's like, okay.
Yeah, it's not always the case, right? Because when jobs is too hot, the calculus there is, well, the Fed is going to keep rates higher because too many people are employed, and therefore contributing to inflation. I think that needs to stop. It hasn't always been the case, but it's rightfully so in 2022 been the focus. But every trade, like we're seeing in this very moment, outside of this newsletter, how sharp the upside to the small caps and mid caps are relative to the S&P.
Yeah.
Like rate cuts really shouldn't be the story. Fundamentally, it should be the economy. Yes, rates influence the economy, and also earnings, which in turn are influenced by the economy. But the fact that we're ignoring some really good small and mid cap companies, again, I hate the term, but the market might be missing this. And if there were a turn or an actual cut, we would expect small and mid cap companies to really catch up, if not outperform large cap.
Well, we've maintained our slight overweight position to mid and
Yes.
small companies, and sort of an equal weight position to U.S. large. And what I mean by that is, if you look at kind of global benchmarks, mid-size and small-size companies are a dot on the radar. I mean, it's tiny because these companies are
less
so
than
tiny
1%. Yeah.
relative to the big of the big. Say that again.
So we benchmark against the all cap world index, and small caps are about 1% weighting on the index.
Which is very, very small, right?
Yeah.
So like we have a slightly higher allocation than that, and for mid as well, to try to capture those small companies becoming big companies, the next Amazons, the next Nvidias, this kind of thing. And historically speaking, by doing that, you can be additive to return and reductive in risk. And last number of years, it's really been a large cap leading it up and down, and then back up. And so I think Howe's point here is, as rates come down, companies that have less piles and piles of cash, i.e., not the Mag 7, should perform better, or could perform better, because rates being lower lowers their debt service, which improves their bottom line.
Yeah. And the next category will be real estate. I know we talked about residential, but I wanted to touch on other real estate, right? Think industrial, storage, service space, and other like commercial properties, where a lot of those traditionally are debt funded or debt operated. And the higher the rates, the more expensive it is to operate. So if rates go down or expected to go down, these companies will benefit.
So, and then you also have in here, dollar should start to weaken.
Yeah.
You kept it in there. And maybe speak to that, and then also speak to how that works with international emerging market investments.
Yeah. So a weakening dollar isn't the worst thing, especially for multinationals who do business overseas, right? Their sales should improve. And internationally, that should help companies selling to the U.S. as well. So
makes sense.
So if the other way around, buying from the U.S. So I always get currency mixed up, but countries that have consumption of U.S. goods, it's relatively cheaper suddenly from their point of view to buy U.S. made products.
Right. Makes sense.
U.S. made products that have been suffering, and this bit of a misnomer, Disney World, right? 24% of their visitors are historically international visitors. And I think we've mentioned how expensive it is for a U.S. person to go. Imagine how expensive it is for a Japanese visitor to go, because their exchange is so poor relative to what they've experienced in the past. So that should improve. Then what should hurt is a U.S. dollar going further somewhere else. So traveling internationally won't be as fruitful as it is now. And I think that's probably a healthy thing, is like we bring tourists back into the country and also sell our U.S. goods, and hopefully bring down our trade deficit. I think that's a big part of the U.S. debt is we import more than we export, and that's been the case for quite a few years. And I think that should swing a little bit. It won't completely erase the trade deficit, but that should help, and therefore in turn help the deficit, like the U.S. government deficit.
I like it. Well, we'll see if it happens. I mean, if you stick with it long enough, you'll probably be right. So the dollar will weaken, and but all jokes aside, I mean, what you're saying makes sense, right? And as rates come down, that should have an impact on the dollar.
It should. Yep.
So, okay. Well, good. Well, thanks for your time, Hao, today, and everybody, make sure to hop onto our website and go to the Insights section, and you'll see market commentaries. You'll see this article posted. Like I mentioned a couple of times here, we've got some really, really great visuals in this one, and so we just encourage everybody to see them. And again, hope this was helpful, and thanks everyone for tuning in.
All right. Talk to you soon.
Thanks.